let's get this started here this morning. Neal, how are you?
Fantastic. Thanks for having me back on the show, Mike.
Yeah, I always love having you on. At least once a year, I think the last few years I've had you on, and what I like is your perspective. You always bring a good perspective about the market, really. The environment where we're at, and what's transforming. So, before we jump in, I just want to ask you to tell people a little bit about you, about your background, who you are, what you do, and then let's get into some details.
Sure. Computer science geek. I'm a data scientist. Joined real estate to save money on taxes because I lived in California and had the big fat tech salary. 10 years of real estate on my own, buying stuff just for me and family. And then the last 10 years in the formal syndication world, 1,020 investors, $300 million of their equity under management. The portfolio used to be a billion, but we've sold a bunch, so it's about 700 million bucks. And what we are known for is data and markets. We're a bunch of data scientists out to disrupt real estate.
It's awesome. So you sold some deals. Were you fortunate enough to sell some before the market started to cycle down?
Yes, all except one. I've only sold one deal in the last year, and it did sell for a 2x profit. But let's put it this way, if I'd sold it a year and a half before that, it would have been a 3x profit.
Hmm. So, can we talk off the record a little bit? Selling that project in the last year, how'd the buyer do?
Um, well, I think the buyer's actually doing okay because the buyer, the price of the property was down from peak about 15, 16, 17%. So I don't, firstly, it was a very nice property and the buyer knew that. So I think that they're going to do fine, but they're going to struggle in terms of their cash flow. And I think the buyer knew that when they were going into the property. It was a 1031 deal, which obviously I like because you could push the price to the max and the buyer's very hungry. And we
Sure.
look for buyers like that at this point of time. So they didn't assume our loan because we didn't have a very low interest rate, and there wasn't much time left on it. But overall, I think the buyer will do fine because they recognized that it was a quality property with a 5-year track record of high economic occupancy.
Yeah, interesting. And you and I were talking a little bit before we got started here this morning, and um, the comment that really kind of stuck out to me that you said was, looking at deals, penciling deals, but because of interest rates being up, it's hard to make anything work. And, you know,
Yeah,
I
yeah.
think we're going through the same thing with a lot of underwriting, but, talk a little bit about that and what's going on with interest rates and where the market's going to go. And are we going to see better pricing from sellers?
Right. There's this feeling that people have, especially when they're new to multifamily, they don't fully understand it, right? There's a buyer-seller gap. Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content. And so people are saying, well, now that rates are up, the buyer-seller gap should come down, right? Whatever the gap is. Maybe I want to pay 30 million, the buyer wants, the seller wants, 31 million. That gap, here's what I'll tell you. It will never come down except for a full-on meltdown. The buyer-seller gap remains the same, right? When I was buying homes that cost $200,000 to build in 2008, and I was buying them for 90,000, Mike, I thought the price should be 80, and the seller
Right.
thought the price should be 100. So the
Right.
buyer seller gap in a percentage was the same in 2008, right? It's just the price varies. So prices of multifamily have dropped 25%. And if you don't think that they've dropped 25%, you don't understand cap rate, because remember, the price per door may not have dropped because the rents have gone up. But on a cap rate basis, the prices have adjusted by 25%. On a per door basis, they might only be down 5 or 10%. You're thinking, well, they're only down 10%. No, they're not, because the NOI of this property has gone up, right? Over the last 2 years, the NOI has gone up because rents have gone up a little bit. And so you have to look at it from that perspective. Prices are down on a cap rate basis by 25%. Check check Marcus and Millichap, check CBRE, check Berkadia. Everyone's talking about it this quarter. We're 25% off the March 2022 peak. But that doesn't mean that the buyer seller gap has adjusted. It's still there, and we're still struggling to kind of make the deals work within that gap. And the best thing that works right now is assumptions. I'll tell you an anecdote. Um, I would tell my team, I only want to look at assumptions, because assumptions are the best thing you can possibly imagine today, because the only reason multifamily prices are down so much is because of interest rates. So you're getting a benefit in terms of prices because of interest rates. But if you assume a low loan, well, you don't have exposure to those interest rates. You're getting the interest rates of 2022 and the prices of 2024, and that's just an incredible deal to get. And so what I did was, yeah, I would go to my team and say, I only want to see assumption deals. Oh, we can't find them. We can't find them. Okay, I'm going to take all of your bonuses away, and I'm going to double your bonuses on assumptions. So they had $10,000 bonuses per close. So I said, your bonus on a non-assumable property is now 1,000, and on an assumable property, it's 20,000. And within 8 weeks, the number of assumable properties in my weekly, pitch sessions has almost tripled.
So isn't that interesting? That's the old carrot and stick model, right?
Yep.
So one comment I wanted to make when you were talking about cycling out of those deals, though, is that, good friend of mine always says that there's no geniuses in this business. There's only cycles. It's all market cycles.
Yeah.
And even though that we're in this quandary right now, we're going to come out of it. And
Mhm.
I think a lot of people forget that, especially if you're a private investor looking for an opportunity to get involved in. Coming out of this, you're going to be in a really good position because you'll be in front of the bull run, and that's really where you want to
Absolutely.
position yourself.
Yes. Yeah. People ask me, what is your mindset right now? One word: greedy. Greedy.
Love
Right?
that.
2 years ago, my mindset: fearful. It was so easy to raise money 2 years ago, Mike. If you had a $30 million raise, you got it done in 2 weeks. Today, a $10 million raise takes 5 times as much time, right? And what's interesting is every deal today is better. All of them are better than before, because the price cannot be changed, but the interest rate can be,
Yeah.
right? So once you lock in a low price, you just locked in until the day you sell it. So to me, this is a good time to buy. I wouldn't say it's great at this point in time, but it's a good time to buy. To make it great, I'd like to see more rent growth. Rent growth in the last year in the Southeast has been about -1%. In the West, it's been -1%. And in the Midwest, it's been about +2%. And Northeast has been +2%. So these are not great um, rent growth numbers. What I really want to see is, I want to see the Southeast turn back to positive rent growth. And the only reason that Southeast is at negative rent growth is they have a huge amount of supply coming in this year. And that supply mostly starts to end about 6 months from now. In some markets, it ends 9 months from now, and in Phoenix, it ends 12 months from now. So we know that supply is going to end, because we know that permits have dropped, new construction has dropped, and so that new construction that was started in 2022 is now delivering, but the one that was starting in 2023 was a lot less. And what we are starting in 2024 is, in some markets, is extremely less. Like Texas is down 70% for 2024 multifamily starts.
Hmm.
You know what that means? In 2027, right? You're going to see very large increases, because Texas is still, at this point, unquestionably, check you all, the number one market for people to move to. Hasn't changed. But the market's suffering because it has a large amount of inventory coming in at this point in time. And I look at that as an opportunity, because if
Right.
you haven't seen any rent growth in the last 12 months, your broker, when it's pricing the property, is going to be very careful. And Everyone who's underwriting is underwriting 1% or 2% growth. What they don't realize is, as you said, Mike, it's a cycle. Rents don't stay 2, 2, 2, 2. They're often 0, 1, 3, 7, then back to 5. There's a cycle for rents, and we're in the low cycle of rents. But once again, once you buy the asset, if the rents go up, yeah, and there will be an upcycle. There's no doubt in my mind there'll be an upcycle for rents. And there's people who don't understand this. And I'm going to, in two numbers, explain to you why anyone who thinks rent growth is not going to be strong in the next 5 years is not data driven. I was going to say an idiot, but I'm just going to say not data driven. Okay. I'll give you three numbers. Since COVID, the average mortgage in the United States is up 111%. 111% in 4 years and 3 months. Okay. And that's a combination of 44% increase in home prices and doubling of mortgages, doubling of interest rates, right? So combination of that, 111. Now, incomes are up 19.7%. So you have 111% increase in mortgages and a 19.7% increase in incomes. But the coolest number is the third one. Increase in rents is 19.6. So rent increases and income increases are exactly matching since COVID in the last 4 years, which means multifamily is fundamentally in the right place for future rent increases. Because when you look at the gap on the single family side, 19 to 111. When you look at the gap between on the multifamily side, 19 and 19. There's headroom here. There isn't a glass ceiling for rents, going forward, because now wages are growing faster than inflation. For a while, inflation was faster than wages, but for the last 15 months in the US, wages are growing faster than inflation, which means that people's buying power is increasing, but rents are not increasing because of that incoming supply.
Hmm.
So when the supply goes away, people have the ability to pay more. And all of a sudden, you have less supply coming in. You have less, people with Class A buildings with 2 months off. That's what happens to rent growth. And that's why, really.
So what's really interesting is I'm loving everything you've said, and you've got my mind spinning, right? So assumptions, I bought 300 units last year on assumptions, but I also bought a nice unit that we did creative owner financing with that had a
Love it.
low fixed rate interest below 3%. So, there's all kinds of deals out there if people look for them. So I'm glad that you've kind of done the carrot and stick thing with your team to get them on the right track for that. But I don't want to give away too much this morning, Neil.
Sure.
Right? And I think your perspective may change over the next couple of months a little bit because
It
we have the
always
summit
changes.
coming. Yep.
Hopefully not too
Right.
much.
Um, but the my multifamily virtual summit is coming up October 17th and 18th this year. You're going to be one of the keynote speakers. You're going to talk about, well, why don't you tell people what you're going to be talking
Sure.
about at the summit this year?
I'm going to expand on some of the stuff that I talked about today, but I'm going to take a very specific perspective, and that is investors. Most investors are speculators. And if you're in the multifamily business, your job today is, you want to buy properties, right? Based on what I just said. But getting in convincing investors when they've had 2 years of no cash flow and cash calls and things like that is a harder job. So I'm going to basically walk you through the top 10 questions that investors are asking, which are irrational, and I'm going to give you the specific answers that you need to give them to immediately get money from them, right? And I'm not going to give you the answers because that's what you come to Mike's Summit
Uh,
for, but I'm going to give you the questions. So, and some of these will immediately resonate, right? Irrational question number one. I can earn 5% in a money market account right now. That is a very, very stupid question because it's not an apples to apples comparison. Just as a teaser, it will not stay at 5%, right? You'll get 5% for maybe 9 more months. So we'll talk about that. All my friends are telling me we've had cash calls and no cash flow for 2 years. Why should I invest? That's why. That's why. Because they've had it, right? So I read there's a $1.4 trillion cliff coming for commercial real estate loans. Yeah, that's also a really great one, and we have a great answer for that. Multifamily values are going down. Why should I invest? What if I invest and then prices go down another 5 or 10%? These are the kind of silly questions that investors are asking. I'm going to break them down for you and tell you exactly what you need to say in 30 seconds or less. And that's what you need to say because right now you need to be greedy. And the only way for you to be greedy is to get your investors to be greedy.
and raise rents.
Yeah.
Right.
Well,
So,
I'm raising rents. I'll wait until the beginning of 2025. So I'll give myself 6 months just for this supply glut to end. It will end. I look at CoStar as if it's God. I look at it every quarter and I say, okay, market by market, when is the glut ending? Because CoStar is very good at looking at incoming supply and looking at lease ups and things like that. And their predictions change every month as more and more properties get leased up. Yeah, the glut will end in most markets by Q1 of next year. So that's not much. If you start working on a project now, you won't even own it until October or November.
right, exactly, because it's going to take you that long to close, especially if you're doing agency financing. But a
Yeah.
lot of these things will be covered at the summit, right? Because before you speak, we're going to have, 18 other speakers and panelists that are going to be talking about how to get into business, how to drive your business. If you're already in the business, this is going to give you a shot in the arm, maybe get you off the sidelines a little bit. If you're a passive investor coming to the summit this year, you're going to understand a lot of these fundamentals and metrics. One of the things you said before we started this morning too was that it seems like it's easier to raise capital today, where,
It
I
started to
think,
get easier for me because I'm very good at telling my investors this story.
yeah.
And it's taken them a while to believe me. It was actually harder to raise money in 2023. It's easier in 2024 because I'm able to demonstrate to my investors that the multifamily market will bottom this year.
Hmm. Isn't that interesting? And I love that piece because I remember you've been on the summit a couple of the last couple of years, and I've
Yep.
had you on my podcast the last couple of years. And you know what? 2 years ago, you weren't saying that. You were saying that maybe the glory days are over. But what I'm hearing you say today is that the glory days maybe are back. And
Well, that's because rates stayed too high for too long. If the rates had gone down after 1 year of being high, sure. But after 2 years of being high, a window of opportunity was created where
mm,
prices, instead of going down 10 or 15%, which is no big deal, are down 25%.
yeah.
They're down too much.
Yeah. And I've read a couple articles recently that talk about prices coming down. And I just read an article about rents the last 2 months that have been up, under 1%, but they have still generally populated up. And I'm even seeing it in some of our deals in some of the other markets we're in. So, I think that we have exciting times coming up in the multifamily business. I think there'll be a lot of insight come October and from you and some of the other speakers. Neal, now I know you've been at the summit before and you kind of hung around, listen to some of the other speakers. Is there anything that you might want to tell the listeners that why they should be there?
Because of timing. I think that I'm telling you, last year the timing wasn't this good. 2 years ago, the timing was horrible. This is good timing. Timing matters.
Mm,
Given you can't time the market, if you find yourself in the right sweet spot, you have to monetize that. Because who knows when the next time, you're going to see something like this. I fundamentally believe that within the next 5 years, we're going to see a massive inflation spike. Well, massive inflation spike for 1 year. The US is a very well-run economy, so it may not last longer than a year. But a single inflation spike will 2x your investors' money. Just
mm,
one for maybe a 10%, 12%, 13% rent growth. You're done. Remember, the magic of multifamily is leverage. 1 year of 10% rent growth takes you all the way to pro forma.
yeah, 100%. Well, listen, I really appreciate your time. Thanks for being here this morning. I'm going to move you to the back room, say goodbye. If you hang out with me for a minute, that'd be great.
Sounds good.
Tell people how they get a hold of you, Neal.
Um, just Google my name, Neal Bawa. I'm the only Neal Bawa on the World Wide Web. You can also go to multifamilyu.com.
And as I learned today, you spell Neal Neal, right? So when you go to
That's right.
look for Neal on LinkedIn or Google, just put in Neal Bawa.
Bawa, Bawa.
Awesome. Thanks for being here. I'll talk to you in a minute.